Navigating the 2026 housing market is exhausting. If you've spent any time looking for a home recently, you likely feel like you're endlessly wandering through a market where every door is locked and every price is out of reach. Then you see an ad from a major home builder that ignores the laws of physics. It says, "Stop renting. Lock in a 3.99% interest rate today." Anyone following the news knows that standard mortgage rates are currently closer to 8%. Seeing a 3 or 4% offer feels like finding an oasis. The numbers simply don't align with the reality of the 2026 economy. The natural assumption is that the builder is sacrificing their own profit to help you afford a home. But there is a specific mechanism at play here that suggests a very different motivation. This offer relies on accounting that stays hidden until you're already living in the house. By the time that layer is revealed, the math of your mortgage will look very different than it did on move-in day. To survive this market, you must look past the emotional relief of a low monthly payment and forensically examine the contract you are actually being asked to sign. Let's look at exactly how this happens on the ground. You walk into a pristine new construction model home. It smells like fresh paint and expensive candles, and there's a friendly salesperson, we'll call him Chad, waiting for you with an iPad. The house is listed at $500,000. At a standard 7% interest rate, the principal and interest alone would cost you $3,300 a month. For most people, that number is an absolute deal breaker. You tell Chad the payment is just too high. Chad has a ready-made solution, the 2-1 temporary buy-down. He offers you a 5% rate for the first year and a 6% rate for the second, before it resets to the market rate for the remainder of the 30-year loan. Your starting payment drops to $2,600. Suddenly, the primary fear of not being able to afford the monthly bill vanishes, replaced by the relief of saving $700 a month right away. The builder is using that relief to focus your attention away from the total cost of the asset. By solving your immediate problem, the monthly payment, they ensure you don't look too closely at where that saved money is actually coming from. It's important to understand the bank hasn't actually lowered their interest rate. They still demand their full market yield on every dollar they lend. Instead, the builder takes a lump sum, often $15,000, and deposits it into a specialized escrow account. For 2 years, money is pulled out monthly to pay the bank the difference between your promotional rate and the true market rate. This is a temporary subsidy. The builder is essentially paying a portion of your mortgage on your behalf for a short period of time. Since home builders are profit-driven corporations with shareholders to answer to, this raises a necessary question. How can they afford to hand over thousands of dollars to fund that escrow account? Think of a store manager selling a television. The TV should cost $800, but the manager changes the price tag to $1,000 and offers to hand you $200 in cash right now to help you pay for it. You would likely see the absurdity immediately. You tell him to just sell you the TV for the original $800 price. In the housing market, a home's value, materials, labor, standard profit, might dictate a $485,000 price. But builders set the price at $500,000. They detach that $15,000 in price inflation, using it to fund the escrow account paying for your lower rate. You are financing your own discount. You've taken out a larger loan and will pay interest on that higher principal for 30 years, just to have your own money handed back to you over the first 24 months. If the house isn't actually selling at $500,000, we have to ask why the builder wouldn't simply lower the asking price to $485,000 instead. The rate buy-down is a self-funded mechanism. It allows the builder to protect their inflated property valuations and maintain neighborhood price records, while the buyer takes on the long-term cost of a higher principal balance. When builders construct an entire new subdivision, dozens or even hundreds of houses are built and sold on the same street at exactly the same time. The financial model of that entire operation hinges on one metric: comparable sales, or comps. If a neighborhood is meant to appraise at $500,000 and a builder sells a house for $480,000, that price becomes the official public record. Appraisers adjust their math, and that $480,000 valuation cascades to every remaining house, lowering the value of the entire unsold inventory. To protect the profit margins of the wider development, corporate home builders are incentivized to protect their base prices. They will go to great lengths to avoid cutting the official sticker price. Instead of a price cut, they offer a workaround. They keep the $500,000 public price tag intact, but offer the buyer a temporary rate buy-down. This maneuver satisfies the bank appraisers, who log a $500,000 sale, while the buyer receives a subsidized monthly payment for the first few years. For the first 2 years, the buyer lives in a honeymoon phase. Payments are low, the house is new, and the math works perfectly. This temporary affordability is a tool for the builder to maintain their project's high valuation, while the buyer begins homeownership under a very short, subsidized window. Eventually, year 3 arrives. At that point, the builder's contribution to the escrow account runs completely dry, and the subsidy stops immediately. The mortgage interest rate, which had been artificially low, now snaps back to its original 7%. As the graph transitions into a bar chart, you can see the result. The monthly mortgage payment jumps from $2,600 to $3,300 practically overnight. In the mortgage industry, this sudden, heavy increase in financial burden is known as payment shock. The buyer is now facing the true, unshielded cost of the home, turning a perceived discount into an immediate strain on their monthly budget. Real estate agents often downplay this risk with a common catchphrase: marry the house, date the rate. This advice relies on a specific assumption that the Federal Reserve will lower interest rates to 4 or 5% within the next 24 months, allowing the buyer to refinance. But the Federal Reserve prioritizes fighting inflation. If inflation remains high, decision makers can keep rates exactly where they are for years, regardless of a buyer's timeline. Betting a family's personal financial security on unpredictable shifts in federal economic policy is a high-stakes strategy with no guarantee of a payout. Even in the best-case scenario where interest rates do drop to 5%, the buyer still faces a significant technical hurdle. To refinance a mortgage, a bank requires an independent appraisal to prove the buyer has sufficient equity in the property. If the broader market has cooled, an appraiser might value the home at $470,000. As this scale shows, that leaves the buyer with a $500,000 loan balance on a house that is worth $30,000 less than they owe. Because the buyer is now mathematically underwater, the bank will refuse to refinance the loan. The gateway to a lower rate is effectively locked. The buyer is now trapped between a monthly payment they can't afford and a loan balance that prevents them from lowering that payment or selling without taking a loss. This structure leaves the buyer holding an oversized loan and an unsustainable payment long after the initial discount has faded. If you want to see the real math behind money without the institutional jargon, hit the subscribe button to support the channel. To avoid this situation, we have to look back at the original negotiation between the buyer and the builder. When a builder offers a $15,000 rate buy-down, they are confirming that they have $15,000 of profit margin they are willing to give up to move the house. Instead of accepting the buy-down, a buyer can demand a $15,000 reduction to the base price of the home. Builders will often point to company policy or neighborhood comps to avoid this, but if they have the cash for a buy-down, they have the ability to lower the price. The difference is clear in this comparison. A rate buy-down is a temporary fix that disappears after year 2, while a price reduction is a permanent decrease in the total amount of debt you owe. The housing market often focuses the consumer on the monthly payment, while the total underlying cost is being manipulated. Always look past the offer of free money to see who is actually paying for it. In the game of real estate, the house always wins.